Welcome to Conversations with Frank Fabozzi. I'm Frank Fabozzi. My guest today is Kari Vatanen. He's the head of asset allocation and alternatives at ELO Mutual, a pension insurance company in Helsinki, Finland. He joined that fairly recently in November of 2024. Prior to that, he was the CIO of Veritas Pension Insurance Company in Finland. He has held other positions at asset management firms, senior portfolio analyst, research manager / quantitative analyst, director and head of cross assets and allocation, quantitative strategy portfolio manager, and chief risk officer. He's also on the editorial advisory board of the Journal of Portfolio Management and has been a frequent contributor to the journal and has a lot more forthcoming over the next year. He has a master's degree in engineering, physics, and mathematics from the Helsinki University of Technology and a master's in philosophy from the University of Helsinki. He holds the CFA and FRN designations. Welcome, Kari.
Thank you. Thank you for the invitation. It's great to be here.
Yeah, thank you for taking the time to do this. As I just mentioned, you've held senior roles across risk management, derivatives, asset allocation during your career. How has this broad experience influenced the way you approach total portfolio construction today?
Let's start. When I started asset management, I was a young student of mathematics, and I started with quantitative analyst roles. And of course, when starting doing portfolio analysis, factors, risks were quite evident. I was interested to understand what are the drivers of returns and risk in a portfolio, and I think that has been important for me during my career, just to understand how markets work, what are the drivers of returns and risk. And as a when being in a risk management role, I was user of MSCI Barra model, which is factor-based model, and that also helped a lot of understanding how to construct factor-based risk models. And I think that the model was brilliant in that time, 15 years ago. And I think that's also one important part of TPA is just to understand the factors which are affecting the returns of asset classes instead of allocating the asset classes, allocating the factors, and try to diversify portfolios which are based on factors and they generated returns.
Yeah. As head of asset allocation and alternatives at ELO, how do you think about the balance between traditional assets and alternatives in constructing a resilient pension portfolio?
I think how the alternatives have been used in Finnish pension portfolios, they are being diversifiers with relative good expected returns. And I think that if we take the average allocation of Finnish pension insurance companies, we can call that 60-40, where 40 refers to illiquid assets and alternatives, which is quite heavy allocation compared to many global peers. And I think that it hasn't been intentionally to have that high allocation, but it's more evolutionary process during the zero rate environment in 2010s. Because at that time, rate levels were around zero, even negative in euro area. And we need to find diversifying sources of return to replace bonds in our asset allocation. And typically in that time, alternatives, illiquid assets were quite good candidates for that, both in a real estate side, private debt, but also private equity, which looked artificially quite non-risky in our portfolio.
Well, many institutional investors are reconsidering, at least here in the US, the traditional 60-40 portfolio. Its history I don't totally understand. But from your perspective, what has fundamentally changed that requires a different approach to strategic asset allocation?
I think, first of all, I think it's important to question each investor should question himself, why should I have 60-40 portfolio? What is the role of 40 in the portfolio? It's clear that 60 is for growth and seeking long-term expected returns, but 40, is it diversifying equity part? Is it generating cash flow, or is it only scaling equity risk down within the portfolio? And then when you understand what you are trying to achieve with the 40 portfolio, then you can find other solutions as well for that. If it's just only scaling down equity risk, it can be cash. If you are worried on duration risk, and if you want more diversification, it can be more alternatives to have there. If you need more cash flow generating asset class, real estate might generate that, especially if you are owning them directly in your balance sheet and don't need to evaluate them very often and can use quite conservative valuations. And when I'm talking about alternative asset classes in this context, I'm asking why to have 40% of bonds in your portfolio. Are they providing diversification? It's highly dependent on your correlation assumptions. And at the moment, when we have a little bit worries on a rising inflation, we've noticed that in the markets, the correlation between equities and bonds have been positive, which means that bonds might not be a good diversifier. Once again, if we are worried on inflation, that means that also the bond returns, especially real returns, might not be enough to fulfill your return targets. And that's why I think that what has changed in the market is that the bonds are not clearly the only diversifier. Maybe they are not diversifier at all, and they might not provide enough returns to your portfolio when you're trying to diversify your equity risk.
Well, given your background in derivatives, how do you see derivatives contributing to portfolio efficiency in a pension fund context beyond their traditional use for hedging?
I would like to start first of all in hedging, because I think that derivatives are really good instruments to manage your portfolio risk, especially if you are regulated pension investors and you have to be solvent in every day and you have to manage your risk dynamically. Equity derivatives, what we are using a lot, both futures and options, to modify our risk exposure in the portfolio and modify also the expected return distribution. They are really good for that perspective. But of course, you have to be careful that you know what you do when you are modifying the return distributions. That's maybe one of the most important part for me, but also options and futures, other derivatives, they are providing other kind of toolbox for different purposes. They are good for discretionary position taking. If you want to track some macro trends in the markets in any asset classes, equities, FX, bonds, commodities, or they are good toolbox for systematic strategies. If you want to implement some alternative risk premium strategies within your portfolio, that's easy to do with the derivatives, either in-house implementations or use some bank strategies.
Well, I don't know your experience with this, but alternative risk premium strategies have attracted considerable attention from institutional investors in the US. What's been your experience with these strategies, if you've had any? And what practical challenges should investors be aware of before allocating to them?
Mm. I think we started study alternative risk premium strategies already over 10 years ago in the Nordic countries, and I think that Finnish, Swedish, and Danish investors were early adapters there in the first phase. And also, I started my trading career with derivatives, both trading discretionary macro trades, but also by constructing some systematic strategies like alternative risk premium. I started trading with short volatility strategies, meaning capturing a volatility risk premium, but also modeled trend following strategies, CTAs in different asset classes, and little by little added some other systematic strategies. And at that time, at the beginning of 2010s, that was quite good time to do that because markets were still let's say that the markets were not crowded at that time with alternative risk premiums. Most of the strategies worked quite well in that time, and also investment banks were providing a lot of research on that area. There was a lot of academic research rising also in that, and a lot of information available how the markets behave and how different strategies behave. And I think the first generation, how I call that, first generation objective was to create something which is totally independent on any market variables, long short strategies which were thought to be totally independent on equities or bonds, and then where the correlations between different strategies were quite low, it was an attempt to create all-weather portfolios that performs in any kind of market environment. But what happened in real life was quant winter in 18, 19, 20, and we noticed that the strategies weren't that independent on equities, bonds, or any other market variables. And that was a really hard time for systematic strategies. And after that, my thinking on ARP has changed quite a lot, and even wrote some a couple of papers on that idea. And I nowadays I call that second generation think ARP they are tools for portfolio construction. You have to know beforehand how they behave in different market environment, if they are dependent on equities or bonds in the tail events, and what are the return drivers? Are they existent still, or is crowding basically taking out the expected returns on strategies? I think that you have to be more careful nowadays selecting strategies and understanding them compared to that time in the early 2010s when most of them worked properly.
Let's turn to, well, liquidity management. And that's obviously a critical issue for pension investors that want to increase their allocation to private markets. How do you think about balancing the benefits of illiquidity premia with the need for portfolio flexibility?
I think that's a big issue in the markets at the moment. It's illiquidity premia. If it exists still, or is it positive or negative in future? And maybe the reason for that is that quite many investors are stuck with private markets because activity has been quite slow in recent years there. And also us, because as I mentioned earlier, we have increased our alternative assets in our asset allocation illiquids, which means that we are also involved there. And we are a little bit suffering the situation that activity is low. There are less distribution, less capital calls, which means that commitments will accumulate little by little if the activity won't rise, and that causes, of course, some kind of liquidity concerns over time. And I think that many investors are still used to see that they can forecast the liquidity profile of illiquid assets, but I think that has totally changed now. And to be honest, it's really hard to forecast what's going to happen to private equity markets in future, what's going to happen in private debt markets in future, and that's why we have to be prepared to have liquidity from other sources. And then we have to go to the liquid market side of the portfolios. We cannot keep too much allocation in cash and liquid bonds due to the fact that rates are still quite low, especially here in Europe. But then we have to think, oh, are there any sources of liquidity? And there are. If we are talking about large cap equities, large cap equity markets in Europe, in US, they are quite liquid. Also, I remember at the time of global financial crisis when there were liquidity problems with many markets. US and European large cap equities, they stayed liquid all the time, and we were able to trade futures in a big size also during the crisis, which means that there's always some kind of liquidity buffer if you can translate your cash equities to futures and take liquidity out. But of course, this is for crisis situation, but we still need to be aware that there's liquidity somewhere.
Having served previously as a chief risk officer, how do you view the relationship between the risk function and the asset allocation function within an institutional investment organization?
Yeah, I think that's in good investment organization, risk management function and allocation. They can live in symbiosis, and of course, I think for me it's a little bit easier because I can speak same language with the risk guys because I've been there before. And what that symbiosis for me means is that instead of only reporting on past risks and past returns in the portfolio, risk management unit can be very useful analysis unit for understanding future risks, understanding different kind of market scenarios. And I think what is maybe the most hardest, let's say hardest problem in risk management is that we are always prepared to hedge past risks, but it's really hard to make scenarios of the risks we haven't seen yet. And I think in that kind of thinking and idea generation, the good relationship with risk management unit is very useful for us, the allocation function. But of course, we have to keep into account the governance issues. Typically, risk management is second line of defense. Risk taking is the first line of defense, and we have to keep the independence of risk management and risk taking to keep the good governance structure within the organization.
Yeah. I've observed that ESG and responsible investing considerations, they seem to become central to European pension funds. In the US, I've been observing uh, some pension funds moving away from that area unless they have political pressure. How do you approach the challenge of integrating sustainability objectives while maintaining a strong focus on risk adjusted returns?
Let's say we started to implement ESG policies around 10 years ago. And during that 10 years, our approach has changed quite a lot. Because in early days, 10 years ago, I remember that ESG was mainly exclusion lists, maybe exclude some sectors. And it was closer to some, let's call it ethical type of investing. But nowadays, what seems to be mainstream in the Nordic countries is to implement ESG analysis to the whole investment process, and which means that it's part of our financial analysis, what we do with companies all the time, both in equities and bond side. And instead of strict exclusion, we now concentrate more to engagement. We want to discuss with the companies we own. We want to be active owners, especially in the local companies where we are meaningful owners, and then discuss what they are doing for the company structures, how their governance work. I think it's important also for financial results that the company governance is in a good condition, but also social responsibility, how the companies behave might also affect the returns, financial returns of the companies. And of course, environment, how to implement environment in the long run. I think it's ESG for us, it's more discussion with companies. With the financial discussion, we can also ask of the long-term objectives with different ESG factors. And then I think that exclusion is only the last possibility when we cannot get any kind of response when we are trying to discuss with companies. And when doing in that way, underlying the governance structure and the good how they behave in the markets, I think that's even positive for returns in the long run.
Well, you've been in the business a long time. I mean, governance was never something that was uh, you always considered governance no matter what. So it's really the E and the S that
Yeah.
become critical. And in addition, it seems like your approach is not to try to quantify. We have a lot of people, a lot of organizations here that try to give a rating for E, S, and G, and then somehow combine them. You look more at the story than looking at trying to quantitative all three of those pillars. Is that correct?
Yeah, it's great, and the reason that I think also the other investors in the Nordics they think that scores can be misleading. It's quite noisy information, and in fact, I think it's like in a credit side. If you have companies with lower credit ratings, but you know that they will be better in future, they are doing a work to getting the better companies in financial terms. It's same thing. Companies with the low ESG scores, which are trying to change their operation model, they might be really good investments.
Right. Yeah. Well, right now, don't you have a concern that since everyone's aware of this, they'll they'll construct their information to investors to so that they look like they're very good with respect to ESG and responsible investing. So trying to filter out the hype from what they actually do is just it's not that easy.
That's true, and I even think that let's say 5 years ago, even more, ESG was mainly based on volunteer reporting, and I think that was more efficient compared to regulatory reporting what we have already now. Because I think that anytime the things comes to regulation, they start to be only reporting exercises with no content. And that's I think the right approach to ESG is to find volunteer things what the companies would like to do.
Yeah. Well, I get a lot of flow of papers on for journal portfolio management, and I'll get papers that will show that if you follow ESG, your risk adjusted returns will be higher. I, I don't know how that is. I haven't seen any solid empirical evidence. I've seen people play with the starting dates, and there's various ways. Have you ever seen, you know, in your process of reviewing various reports, any solid evidence that ESG results in superior risk adjusted returns?
Uh, to be honest, I haven't seen any research that confirm me in that size. Let's say that maybe with governance and quality factor, there are some similarities. Governance can work as a quality measure for companies, but for other measures, nothing that is basically that I can believe easily in.
From your experience, what are the most common mistakes institutional investors make when expanding into alternative investments?
What I see quite a lot here in the Nordics, but also other international, nationally, other investors to do is that they are thinking that the asset classes are separate to any market environments. And let's say we are talking about private equity. They think that private equity is not highly correlated with equities. It's it's not highly correlated to the reporting lags and smoothing of prices, but in fact, there are some fundamental factors driving the returns. And I think the mistake there is just to believe that private equity can provide 15% IRR in any kind of environment. And so on, private credit as well can provide some stable stream of returns over time, because I really think that they are affected by factors, but you cannot measure them due to the smooth of pricing and in the funds. And then when you only look the returns and realized risk, you get the covariance matrices, which are not true. And I think that's maybe the biggest thing or biggest mistake I see with investors is just to believe that they can continue to perform in a similar way what we've seen in 2010s when where the rates were low and central banks were uh, giving liquidity to the markets with AQA programs.
How do you see the role of quantitative methods and data science evolving in institutional asset allocation decisions over the next decade or so?
I really think that role models, quantitative methods will increase in the future. And maybe there are two reasons why I believe that. One is that there are all the time more data available for investors to study with. And then, of course, the evolvement of large language models and machine learning is basically you can do quite easily new models with a natural language without knowing how to code things. And I think that if we compare that to the traditional finance, which is mainly based on linear models, linear regressions, nowadays it's quite easy to go beyond that and do non-linear models and explain almost everything. And that also creates the risk when you know that you are able to explain everything. There's a huge risk of on overfitting things. But anyhow, the tools are evolving in a really fast pace, and basically, I'm quite surprised how well it's possible to write Python code even with the Codex OpenAI systems or Cloud Code or any kind of. It's amazing what is available at the moment.
Mhm. Let's turn. We have people who'll be listening to this discussion, and they may not even be in the finance area now because this is made available to anyone. What advice would you give to young professionals interested in building careers in institutional asset allocation, particularly in alternatives and multi-asset investing?
Maybe my biggest advice for them is just not just study the finance, not that study the mathematics. Finance is not only the models. There's a lot of behavioral things which are happening in the markets, and especially when looking the markets, the transition that has happened in last 10 years, it even feels that in some markets the fundamentals is they are not even driving anymore the market behavior. There are retail and flows which are basically explaining how the markets behave. And I think that's important, and that's something what hasn't been taught in traditional financial courses, how things can behave. And of course, I think that's of course having background in theoretical philosophy. It's good to understand human behavior, cultural things, how they affect the markets, and uh, overall, when thinking the financial markets, I think it's more human behavioral science than anything else nowadays.
Yeah, that's interesting because out of all the people I've interviewed over the last 4 years or so, um, very few have degrees in finance.
Yeah.
They have degrees in physics and mathematics. Okay, and physics being the most common, and that's one of the areas you've worked in getting your PhD. Um, and yet, it's interesting you talk about models and understanding the behavioral finance aspect, because in physics you don't do that. There's no, there's certain. I believe there's certain laws and principles where you're not considering that type of behavioral factors. You took the CFA exam. How did your and did you ever take any courses in finance at the university level?
Um, uh, Not at that time. Now I'm taking some courses when doing a PhD in finance, some courses, but not before.
But not. So, how did your background in physics? Because you also had a master's in philosophy, actual philosophy, or is it that?
Yeah.
Okay? How did your background in physics help you in studying for the CFA exam?
I think because I knew the mathematics and knew the models because I had been working in the financial industry around 5+ years before
Wow.
starting to do CFA exams. I've learned everything when working,
Yeah. Okay.
and after that, I think that most of the topics were quite easy in CFA. maybe the financial statement analysis was something I didn't do beforehand as a quant as well, but you can learn that.
Okay, you've now retired. You have an impressive career. The University of Helsinki calls you and said, "You're an outstanding alum. What we want you to do is come in and run our economic finance department." How would you because you were talking about traditional finance? How would you restructure? How would you create a meaningful program in finance?
Hard question. Let's say, of course, there must be some traditional areas. Asset pricing is important. I think the understanding the factors which are affecting the market returns and risks, but also I would little bit have also the behavioral finance courses. And what disturbs me usually in behavioral finance, it's typically repeats the same examples all the time. But I think the real examples are happening now in the markets. In every crisis, the recoveries are faster and faster. And that's the behavior of finance part, what is even more interesting because it's happening at the moment.
Yeah. Okay. Are you done with all your coursework for your PhD in finance?
No, I'm still working that with the work, and it takes some time.
Yeah. Yeah. I mean, what is your dissertation going to be on? Alternatives?
It's about the alternative risk premia, the papers which I've written already.
Oh, okay. All right. Well, listen, it's been wonderful speaking to you. I followed your writings. I know you're going to be writing a few more pieces for different journals. There's also a journal that has just started up, the Journal of uh, um, Private Market Investing. You should get involved with that journal. There's tremendous amount to be learned in that area. There's also people who are writing. There'll be an interview in that journal on sort of criticism of alternatives. I think your perspective would be good. So I'm going to mention to the editor
Okay, thank you.
about that. I think you should get involved. And I appreciate your work you've done for the Journal of Portfolio Management. And with that, I thank you again.
Thank you. Thanks a lot.